All right, let's just jump right into it. Today was all about the A reckoning. It feels like the big AI party might be slowing down just a little bit, and the market is definitely grappling with what feels like a serious AI hangover. We're going to dig into exactly why the king of AI, Nvidia, actually stumbled, while Netflix, a company that chose discipline over a massive buyout, absolutely soared. It's a fascinating story.
So yeah, it was a rough end to the month for the markets. Actually, it was the worst in almost a year. The S&P 500's dip right here, well, it really set a bearish tone for the day, signaling that investors were feeling pretty cautious.
And then you see the Dow. That 500-point drop was way more than just a dip. It was a loud and clear signal of some widespread market anxiety, fueled by these growing inflation fears and this general sense that the easy money days are probably behind us. But here we are at the real epicenter of today's story. The tech-heavy NASDAQ dropped nearly a full percent. And the main culprit? We're calling it AI anxiety. Investors are starting to ask some really tough questions about the billions being poured into artificial intelligence. Okay, first up, Nvidia. As the undisputed king of AI hardware, this company isn't just carrying its own weight anymore. It's shouldering the market's sky-high expectations for the entire AI sector. Literally, the weight of the world on its shoulders. And you can feel that pressure in the stock's 4% slide today. A drop this big in a monster company like Nvidia creates a huge ripple effect. We're talking waves of concern that dragged the entire NASDAQ down with it. So, what's really driving this? Honestly, it's a classic case of being a victim of your own success. Nvidia's earnings report was good, but here's the thing. When your market cap is pushing $5 trillion, good just doesn't cut it anymore. You need perfection. The big fear rattling investors is that if big tech doesn't see a return on investment and fast on all this AI spending, that spending spree could just stop. And this quote just says it all, doesn't it? When you're priced for perfection, even the tiniest sliver of doubt can be incredibly, unbelievably costly. I mean, that's a tough spot to be in, no matter how successful you are. Now for a complete change of pace, let's look at Netflix. While Nvidia was stumbling under all that weight, Netflix absolutely soared. And they did it by making a move that went completely against the grain. Wow, look at that, a nearly 14% surge. That's not just a jump, it's a massive gap up right at the market open, on incredibly heavy volume. Wall Street was clearly blown away, and they were definitely voting with their wallets. So what caused this huge surge? It was all about pure financial discipline. Netflix walked away from an enormous $83 billion deal for Warner Brothers Discovery. Instead of getting sucked into a costly bidding war, they just said no. In a world full of ego-driven mega mergers, this was so refreshingly disciplined. And this really highlights the key lesson here, right? Sometimes the best deal, the most profitable move a company can make, is the one they don't do. Netflix's discipline paid off, big time, and you can be sure investors noticed. Okay, for our third story, we've got a bit of a warning sign from a totally different part of the market. Jefferies Financial found itself in the spotlight, and it's signaling a new and emerging risk in the financial sector that you need to know about. An 11% plunge on high volume. Whoa. I mean, when a major investment bank takes a hit like that, people sit up and pay attention. And for very good reason. So the driver here is basically fear of the unknown. News got out about Jefferies' reported $135 million exposure to a collapsed UK lender, and that has everyone spooked about the hidden risks in the shadow banking world. Think of this as the less regulated side of lending. And now there are serious concerns about practices like double pledging, which is essentially using the same collateral to back multiple loans. Yikes, it really makes you wonder what else is lurking under the surface. So here's the bottom line. Jefferies' problem today serves as a cautionary tale for the entire banking industry. It is a stark reminder that when things go wrong in the less regulated shadow banking world, it's often the traditional banks that end up with a massive headache. All right, so we've gone through the what and the why. Now, let's get to the fun part. Here is exactly what you can say to sound like you've got this all figured out at the water cooler tomorrow morning. On Nvidia, here's your take. The sell-off in Nvidia this week is a huge signal. It's not about the chips. It's about the ROI for the buyers. The market is finally starting to ask, if OpenAI and Meta are spending hundreds of billions on this infrastructure, when do they actually get their money back? Until we see real software monetization, the hardware multiples are going to stay under pressure. And when someone brings up Netflix, you can say this. You have to respect the capital discipline Netflix showed today. Walking away from an $83 billion acquisition of Warner Bros. Because the math stopped making sense is almost unheard of in media. Most management teams would have let their egos take over and triggered a bidding war. But Netflix just saved their balance sheet and the stock jumped 13% because of it. Finally, on Jefferies, here's the sharp angle. Keep an eye on the Jefferies drop today. They got slammed because of their exposure to that collapsed UK lender MFS. It's a classic private credit blowup. With all the money that has flooded into alternative lending and shadow banking over the last 2 years, this MFS collapse feels like a massive warning sign about loose underwriting standards finally coming home to roost. All right, so that leaves us with one final question for you. Netflix just walked away from buying Warner Bros. Discovery, refusing to get into a bidding war with Paramount. Do you think Netflix made a brilliant move saving their cash, or did they just miss out on a massive content library? Let us know what you think down in the comments. And of course, make sure you subscribe to Market Fluency for your daily edge.